Chetan was drinking coffee in his office canteen. Just then his senior comes there with a cup of coffee. Saurabh asked Chetan whether he had read the news about Hindustan Zinc giving 1300% dividend to shareholders. Chetan replied that he has read the news and also added that he has 100 shares of the company. Saurabh stated that this will give good profit to him and they should celebrate. Chetan agreed to it and asked whether Saurabh has bought shares of Hindustan Zinc or not. Saurabh explained that he invests in mutual funds and not directly in the share market. Chetan stated that Saurabh can get still benefits of dividend. Now Saurabh got curious about how that will happen. Chetan explained that Saurabh can invest in dividend yield mutual fund. Saurabh wanted to know what is dividend yield fund.
You may know that companies often distribute a portion of their profits to shareholders in the form of dividends. If a company is paying dividends, it means that its results are likely to be good and its financial position is strong. Although it is not necessary for every company to pay dividends, companies do so in the interest of both the company and its investors. Companies also give dividends to shareholders because they consider investors to be an important part of their business. You do not receive benefits like dividends in any other investment.
Most investors prefer to invest in shares that have a history of consistently paying good dividends. However, it should be noted that investors who prefer lower risk do not want to invest directly in shares. What should such investors do if they want to take advantage of dividend-paying shares? For such investors, dividend yield funds can be a good option. First, let's understand what dividend yield funds are and how they work. Dividends play a significant role in most investors' decisions to purchase shares. So dividend yield funds choose companies with a good cash flow, strong balance sheets and a regular distribution of dividends to shareholders and invest in them.
As per the mandate of the Securities and Exchange Board of India (SEBI), any dividend yield fund scheme must have a minimum investment dividend yielding of at least 65%. Investing more than 65% in shares means that they come under equity funds. For most such funds, the Nifty Dividend Opportunities 50 Index is considered the benchmark. Fund houses select shares paying higher dividends based on this index.
Dividend yield funds generally invest around 70 to 80% of their capital in high dividend yield or payout shares, the ratio of dividend payments and market capital of the company. For example, suppose the price of a share is 500 rupees and the company has given a dividend of 10 rupees per share, then its dividend yield will be 2%. The ratio of a company's total income to its total dividend amount is called the dividend payout ratio. Dividend yield funds provide investors with the opportunity to diversify their investments and participate in different segments of the market.
Now let's see what kind of return dividend yield funds have given. According to Value Research data, dividend yield funds have given an average return of 9.1% in the last 1 year, 29% in 3 years and 11% in 5 years. Dividend yield funds come under equity mutual funds, so they are taxed similarly to equity mutual funds. If you redeem a unit of an equity fund within 1 year of buying it, you will have to pay short-term capital gains tax. If you fall under any income tax bracket, you will have to pay tax on this gain at a uniform rate of 15%. Similarly, the gain that you get on selling a unit of an equity fund after 1 year is called long-term capital gains. Such gains up to 1 lakh rupees are completely tax-free. However, gains above 1 lakh rupees are taxed at a rate of 10% as LTCG tax. This gain is not eligible for indexation benefit.
So, for whom are these funds right for and should you invest in them? Dividend yield funds are less risky compared to small cap, mid cap and growth oriented funds, making them suitable for investors who want to take a moderate level of risk. These funds experience less volatility compared to other equity funds. Dividend yield funds are a good option for investors who do not want to be impacted by market fluctuations. The companies these funds invest in are usually stable and have less volatility. In other words, these funds are suitable for investors who are not very aggressive, as such companies are usually stable.
Investors should keep in mind that dividend yield funds are also equity funds. It is true that they do not experience the same volatility as thematic funds, but they are still affected by market fluctuations. Look for funds with good-sized portfolios, low expense ratios, and less volatility. Overall, it can be said that investors who want good returns with low risk can choose dividend yield funds.